Sometimes you see a company where all the data is just screaming, buy, but at the same time, Wall Street is whispering, hey, be careful. Well, that's a classic analyst's dilemma. And it's exactly what's happening right now with the biopharma giant Gilead Sciences. We've got these incredibly strong signals pointing up, but the market seems to be tapping the brakes. So what is really going on here? In fact, if you look at a comprehensive AI-driven technical analysis, it crunched all the numbers and the verdict is pretty clear. A confident, strong buy for Gilead. I mean, that's a really powerful signal right out of the gate. But, a rating like that is just a starting point. The real question is, what's behind that number? So let's break down the data together, see the full picture, and try to figure out if this bull case really holds water. Okay, first, let's unpack this bull case. What's all the excitement about? Let's dive into the data that's painting such a rosy, strong buy picture for Gilead. It really starts with just the sheer scale of the company. For the full year 2025, Gilead brought in a massive $29.4 billion in revenue. A number that big tells you right away, this isn't just another player, it's a pillar of the entire global market. But here's where it gets really exciting. A staggering 77% year-over-year increase in their non-GAAP earnings per share. Now, that's not just some steady growth. That's a huge leap in profitability that makes any investor sit up and pay attention. And that incredible growth, it's really anchored by their flagship HIV drug, Biktarvy. This thing is an absolute powerhouse. It's considered the gold standard in treatment. It pulled in over $14 billion in sales and commands more than half the entire market in the US. That's the definition of a blockbuster drug. And the technicals, well, they seem to back up this positive story. Sources are pointing to 5 distinct bullish signals flashing on the charts, and they're just completely overwhelming a single bearish one. For anyone who follows technical trading, that's a really compelling ratio. But, and this is a big but, here's the twist. Despite those absolutely stellar numbers from 2025, Wall Street got pretty nervous the moment Gilead released its guidance for the next year. The problem was actually pretty simple. Gilead's own forecast for 2026 just didn't quite live up to Wall Street's really high hopes. And it's that gap between spectacular past performance and a more modest future outlook that triggered all the anxiety. Let's put some concrete numbers on that disconnect. Gilead's midpoint forecast for earnings per share was $8.65. The consensus on Wall Street, $8.75. Now, it might only be a 10-cent difference, but in the world of high finance, a small miss like that can send major ripples through the market. And that slight miss on the headline number was like the first domino to fall. It triggered this whole cascade of very specific concerns. Suddenly, forecasts for new drugs were coming in below expectations. Warnings started popping up about a decline in cell therapy revenue, and worries really grew about rising competition. So, how is Gilead planning to counter all these worries? Well, their answer, and frankly their biggest bet for future growth, lies in one place: their really impressive pipeline of new drugs. The company is banking on what some analysts are calling a three-wheel drive strategy. It's basically a three-pronged attack focused on next-generation treatments. First, continue their dominance in HIV. Second, drive new growth in liver disease. And third, aggressively expand into the huge oncology market. And to really supercharge that oncology ambition, Gilead isn't just sitting around and waiting. Nope, they are putting their money where their mouth is, making a massive bet by acquiring the biotech company Arcellx in a deal worth up to $7.8 billion, all to bolster their next-gen cancer therapies. Okay, so that pipeline is all about future growth. But for a lot of investors, especially those of us looking for some stability, there's another really crucial piece of the puzzle to look at: the dividend. And when it comes to reliability, Gilead has an incredibly strong track record. Get this, the company has increased its dividend payments to shareholders for 10 straight years. That kind of consistency is a powerful signal of some deep financial health. They also have this really healthy balance going on. They pay out just under half of their earnings as dividends, which rewards shareholders, while smartly reinvesting the other half right back into the company to fuel that very pipeline we were just talking about. And this isn't just a recent thing either. The growth in their dividend has been remarkably consistent, showing these steady, annualized increases over the last 1, 3, and even 5 years. Okay, so we've seen the bull case, we've seen the Wall Street worries, the promising pipeline, and the super stable dividend. What does this all add up to for you, the investor? It really boils down to this, a classic investor's dilemma. On one side, you have a highly profitable company that totally dominates its market and pays a strong, reliable dividend. But on the other side, you've got a modest growth forecast, intense competition, and this huge question mark hanging over whether its promising pipeline can actually deliver. So how should you view Gilead? Is it a stable dividend play for a more conservative portfolio? Or is it a high-stakes growth story you want to bet on? You could even argue that Gilead is a victim of its own success, where its current blockbusters set an impossibly high bar for the future. Ultimately, it all comes down to one thing, whether that multi-billion-dollar drug pipeline can turn promise into profit. And that is the question that's going to define Gilead's next chapter.